Hi, this is Sahil Bhatia. I specialize in helping investors and end users navigate Dubai's real estate market with clarity and confidence. Recently, there's been a Fitch report that's created quite a buzz in the market. A lot of my clients have been forwarding it to me, asking, is this something to worry about? And while I have been explaining it one on one, I realized why keep these insights limited. So in this short video, I'll walk you through the key takeaways from the Fitch analysis, what this report actually says, and more importantly, what it really means for your investment decisions heading into 2025 and 2026. This isn't a crash warning, it's a strategic window. Let's dive in. What you are seeing here is a high-level breakdown of experts' insights based on Fitch's latest analysis of the Dubai property market. The headline, this report isn't fueling fear, it's offering clarity. While some people misreading the signs, the data actually tells a story of stability and evolution. We are not heading into a crash. What we are seeing is market maturity. And with that comes strategic opportunities, especially for long-term thinkers who understand how cycles work. Let me break this down for you. Let's start by breaking down what the Fitch report actually said point by point. First, they are forecasting that residential prices in Dubai could see a correction of up to 15% in late 2025 and 2026. But that comes after a 60% surge since 2022. So this isn't a crash, it's a natural adjustment after a period of rapid growth. Second, the main reason behind this correction is a significant supply surge. We are expecting 210,000 to 250,000 new units to hit the market, nearly double what we saw over the past 3 years. The sudden increase in supply is bound to create some temporary pricing pressure. Third, Fitch made it clear that prime locations, areas like Downtown, Business Bay and Sheikh Zayed Road are expected to hold their values better. Why? Because land there is limited, demand stays strong, and most buyers in those zones are long-term players. Fourth, there is no panic on the financial side. Banks and developers are well capitalized and their exposure to real estate has actually been reduced, which doesn't expect any ratings downgrades or financial instability. Fifth, some project delays might happen, but interestingly, that could actually help ease the pressure from oversupply. If fewer units are delivered at once, it gives the market more breathing room. Next, Fitch is not seeing any systemic risk to the economy or banking sector. The correction is expected to be moderate and contained, not something that derails the entire market. And finally, the long-term fundamentals remain strong with continued population growth, international investor interest, and pro-investment government policies. Dubai's real estate story is far from over. Let me now break it down into 4 simple takeaways. This is the real message behind the Fitch report. First, healthy market maturation. What we are seeing is not a collapse, it's a natural evolution. After 60% rise in prices, a moderate correction is not just expected, it's healthy. It shows Dubai is moving from a hype-driven cycle into a more mature, sustainable phase. Second, strategic softening areas. The correction isn't across the board. It's likely to happen mainly in areas with too much supply. Around 210,000 to 250,000 new units are expected, and that surge might cause a bit of softening in oversupplied zones. But here's the catch, some project delays could actually reduce that pressure. And prime zones, they are built on limited land and long-term demand, so they remain far more resilient. Third, strong financial foundation. The backbone of the market, the financial system, is stable. Banks and developers are still strong. In 2024 alone, we saw 761 billion dirham in real estate transactions. That shows confidence. And more importantly, Fitch sees no systemic risk, no threats to banks, no sector-wide distress. And fourth, limited supply advantage. This is the edge prime areas like Downtown, Business Bay, Sheikh Zayed Road and similar such areas hold. Because land is limited and demand is consistent, these zones act like a shield. Even when the broader market adjusts, these areas retain their value. So now the big question, how should investors look at this? Here's how smart investors think in a market like this. First, they see a window of opportunity. Yes, prices might dip in some areas, but that creates entry points. A lot of new supply creates noise in the market, but smart investors stay focused. They know that real returns come from buying right, not timing perfectly. Second, they focus on rental income stability. Even if prices move a bit short term, rental income in prime zones stay strong. 8 to 10% returns are still very achievable, and that's the kind of steady cash flow smart investors love. Third, they reposition strategically. This is the right time to review your portfolio. Maybe sell a weaker asset and use this moment to upgrade into a better location. And fourth, they play the long game. The real wealth in real estate comes from long-term value creation. Market corrections don't scare smart investors. They see them as a chance to grow, especially in areas where limited supply protects their investment. So now that we know what's happening and how smart investors are thinking, here's what I recommend as your action plan if you are considering investing in Dubai real estate. First, target high demand areas. Focus on high demand zones like Business Bay, Sheikh Zayed Road, waterfront properties, and other prime locations where supply is limited and demand stays consistent. This means your investment is more likely to hold its value and even appreciate over time. Second, prioritize rental yields. Look for properties offering 8 to 10% or more rental returns. That kind of cash flow can keep your portfolio healthy and give you more financial flexibility, especially if prices stay flat in the short term. Third, optimize your payment structure. Use flexible payment plans. It allows you to stay liquid while locking in a great property. This way you don't overcommit upfront, but still get exposure to a high potential asset. The bottom line is this: the market isn't crashing, it's adjusting. And for those who know how to navigate it, this phase could be the start of something very profitable. Thanks for watching. I hope this gave you a clearer picture of what's really happening in the Dubai real estate market. If you come across any similar insights and want a clearer explanation, feel free to send them my way. I'll be happy to break them down for you. Also curious to know, does this outlook match how you are seeing the Dubai market right now? Or are you picking up a different pulse? Let's keep the conversation going.